Welcome back to the deep dive. Today, we're taking a close look at SoundHound AI, that's ticker SOUN.
Right. And as of today, December 1st, 2025, it's trading at $12.06 a share with a market cap of, what, just over $5 billion?
$5.06 billion, yeah. So, to set the scene, I want you to think about driving. You're on the highway, maybe you want to find some Thai food.
Okay.
The old way was clunky, right? You had to say, navigate to Thai restaurant. It was robotic.
So it's frustrating.
Exactly. Now you just want to say, hey, find me a good Thai place near the next exit that's open now and let me order ahead.
A real conversation.
That's the whole game. That seamless shift is the future, and SoundHound is positioning itself as the key independent player in that massive fight.
It is, and that really gets to the heart of the dilemma here. The big question everyone's asking is this. Is SoundHound the Switzerland of voice technology? You know, the neutral armed dealer powering everyone.
Right, the one that isn't Apple or Google.
Or is it just a small fish in a pond with some very, very big sharks about to be swallowed whole?
And what's our take after this whole analysis?
Our conclusion is that this is a classic high-risk, high-reward speculative buy. It's sitting, precariously close to its 200-day moving average, which is a huge technical line in the sand.
A real tipping point.
Exactly. So our mission today is to really dissect how this company went from, a music app?
Yeah, basically.
From that to a full-blown enterprise AI platform. We'll look at the tech, the financials, the management, everything, and see if that price tag is justified.
Okay, sounds like a plan. Let's get into it.
We'll need a clear structure for this one.
Part 1, chapters 1 to 3, business, management, and financials. Chapter 1, business understanding.
Okay, and this is maybe the most important part to grasp.
I agree. Because everyone thinks of Siri or Alexa, which are consumer products, B2C. They're designed to trap you in the Apple or Amazon ecosystem.
Right. SoundHound is completely different. It's a pure B2B play.
But they're the arms dealer in the war for voice. They give the tech to other companies who want to control their own brand.
Exactly. And that business has really matured into 3 distinct pillars. First up is product royalties.
Their legacy business.
Pretty much. This is mostly in the auto sector. Think Hyundai, Kia, Stellantis. They design SoundHound's tech into a car.
And SoundHound gets a royalty for every single car sold.
And the key there is the lock-in. Once it's designed in, it's there for the whole 5 to 7 year life cycle of that car model. It's a very high barrier to entry.
Okay, so that's a stable base. What's pillar number 2?
Pillar 2 is the big growth engine. Service subscriptions. This is all about recurring revenue.
Things like their AI for restaurants, handling phone orders.
Exactly that. And, more importantly, the huge enterprise platform they got with the Amelia acquisition. These are super sticky subscriptions because you're replacing expensive human call centers.
Right. And the third pillar, the moonshot.
The moonshot, as you say, is voice commerce. This is where they take a small transaction fee anytime you buy something through the voice assistant.
Ordering that coffee from the car.
Or movie tickets, paying for gas, you name it. Management thinks this is a $35 billion annual opportunity across their platforms. It's huge.
So why would a company like Mercedes go with SoundHound instead of just using Google's tech?
It's all about one thing, brand control and data sovereignty. They provide a white label solution.
Meaning the data stays with Mercedes.
Precisely. Your driving habits, what you ask for, what you buy. That data belongs to the car company, not Google. In a world worried about data monopolies, that neutrality is their single biggest selling point.
Okay, so that's the business model. What about the tech itself, this speech-to-meaning thing?
Yeah, this is their real competitive moat. See, most voice systems use a 2-step process. First, automatic speech recognition, or ASR, turns your voice into text.
Okay.
Then, natural language understanding, NLU, figures out what that text means. SoundHound does it in one step. It goes directly from the sound waves of your speech to meaning.
Bypassing the whole text part.
Which makes it faster. And in a car or at a drive-thru, that speed is absolutely critical. A half-second of lag feels like an eternity.
And this seems to be working. They're a $5 billion company now, and revenue is jumping.
It is. Q3 of 2025 saw a record $42 million in revenue. That's up 68% year over year, and it's backed by this growing backlog of bookings and subscriptions. The demand is definitely real.
Chapter 2, management evaluation.
Let's talk about the people in charge.
Right, starting with the CEO, Kevin Mohager. He's a founder CEO, which is usually a good sign, a real visionary, but he was seriously tested, wasn't he?
Oh, absolutely. The 2022-2023 period was what you'd call a wartime situation. The company almost went under.
Post-SPAC bust. It was brutal for a lot of tech
It
companies.
was, and he made a very tough call. He laid off nearly half the workforce.
50%, wow.
It was brutal, but it saved the company. It showed that his #1 priority became balance sheet health. And now you see them stabilize and executing, which kind of proves that painful decision was the right one.
And as part of that survival plan, they made a really big acquisition, Amelia.
A huge move. It was an $80 million deal in cash and stock, and it was a strategic pivot into what's called agentic AI.
Agentic AI. So this isn't just answering questions.
No, no. This is about AI agents that perform complex multi-step tasks. Things like processing a full customer refund, booking a complicated appointment, handling an HR request from start to finish.
Basically replacing entire job functions.
In a way, yes. And it was a smart way for them to diversify away from being so dependent on the auto industry, which is very cyclical.
But acquisitions like that are risky. How do we know if it's actually paying off?
That's the key question. We look at a metric called return on invested capital, or ROIC. Right now, it's deep in the red, around negative 68%.
That sounds terrible.
It's expected for a company in hypergrowth mode, but it means the pressure is on. That Amelia acquisition has to deliver major cost savings and revenue growth within the next 2 years to get that number moving in the right direction.
And to fund all this growth in these acquisitions, they've had to issue a lot of new shares, right? The dilution has been massive.
It has. The share count went from about 190 million in 2022 to over 400 million now.
So my slice of the pie is getting smaller.
Your slice is smaller, but the hope is that the pie is growing much, much faster. It's the cost of doing business for a company like this. They're funding growth without taking on debt, which gives them flexibility.
Chapter 3, financial health.
Okay, let's look at the actual numbers on the scoreboard.
The bull case really starts and ends with the growth story. I mean, revenue is basically doubling year after year. From $85 million in 2024 to an estimated, $165 to $180 million for 2025.
That's the projection. And that sustained 70+% growth is why the stock gets so much attention.
Their margins look okay, too.
They're respectable. Non-GAAP gross margin is around 59%, and management is aiming for 70%. So the underlying product is profitable. The problem is the company as a whole is still burning cash. They burned through about $76 million in operating cash flow in the first 9 months of this year.
That's a lot of cash, but their balance sheet it's actually really strong.
It is. This is their safety net. They have zero total debt.
Zero debt.
And $269 million in cash on the books. At their current burn rate, that gives them a runway of at least 18 to 24 months. That's a huge comfort.
Okay, so they can survive. But then we get to valuation, and this is where things get complicated.
Complicated is one word for it. You can't use a PE ratio. They don't have earnings. The metric everyone is watching is price to sales, or PS.
And it's sitting at nearly 30 times this year's sales.
29.7x, to be precise, which is an extremely rich valuation.
I mean, the average software company trades for 8 to 12 times sales? So this is pricing in years of absolute perfection.
That's exactly right. You are paying today for the hope of flawless execution and massive success in voice commerce 5 years from now. If they miss a single step, that valuation could fall hard.
Our own DCF model, our intrinsic value calculation, shows just how wide the range of outcomes is here.
It really does. In our bear case, if growth slows to just 15%, we see the stock worth maybe $4.50.
Wow.
Our base case with 30% growth gets us to about $11, so right around where it is now.
And the bull case?
The bull case needs 35% sustained growth plus a big win in voice commerce. That gets you into the $18 to $22 range.
And it's really sensitive to the cost of capital, this WACC number.
Very sensitive. We estimate their WACC at around 17%, which is high. It basically means because the stock is so risky, investors demand a much higher potential return, which heavily discounts those future profits. It just shows how high the bar is set for this company to succeed at its current price.
Okay, that's a lot to digest on the financial front. Before we move on to the second half, a quick word. If you're getting value from us breaking all this down, please take a second and like and subscribe to Stock Analytics AI. It really helps us out.
And remember, for just €4.99 a month, you get access to our full library. That's over 500 deep dive videos on all the S&P 500 stocks. We're adding the NASDAQ 100 next, and you also get access to members-only requested deep dives. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
All right, so how is Wall Street looking at this?
Well, the analyst consensus is a buy, with an average price target of $16.93. But what I find interesting is that the current price, $12.06, is below even the lowest analyst target of $13.
Which suggests that, at least from their perspective, the stock might be oversold right here at this key support level.
But there's another side to that coin, a huge amount of negative sentiment.
A massive amount. This stock is a powder keg because the short interest is incredibly high. We're talking about 30.75% of the float.
So nearly a third of all the available shares are bets that the price will go down.
Exactly, and that creates the perfect setup for a potential short squeeze.
Right, if any good news comes out.
A big contract,
Mhm.
better than expected earnings,
Right.
anything. All those short sellers are forced to buy back their shares to limit their losses.
Which creates a huge, sudden demand for the stock, and the price just explodes upwards.
It can be a violent move,
Yeah.
and it's why the stock is so volatile.
And technically speaking, it's at a very dangerous point. It's in a downtrend below the 50-day moving average. And as we said, it's dancing right on top of that 200-day support line at $12.11. This $12 level is absolutely critical.
Chapter 5, Ownership Structure.
So who actually owns the company?
Well, despite the volatility, you do have some stability from large institutions. Vanguard has over 10%, BlackRock has over 7%. All told, institutions own almost half the company.
Which provides a bit of a floor, but
Mhm.
there's a flashing yellow light on the dashboard when it comes to insiders.
There is. The CEO, Kivan Mohajer, recently sold about 118,000 shares.
For $2.37 million, when the stock is sitting on its most critical support line, that's not a great look.
It's hard to spin that positively. People will say it's for tax purposes, and maybe it is, but it rarely inspires confidence.
And then you have the retail investor component.
Which is huge. Retail investors control a massive 45% of this company. This makes it what we call a meme-adjacent stock.
Meaning it can move wildly based on social media sentiment, not just fundamentals.
Exactly. It just adds another layer of volatility to an already wild ride.
Chapter 6, Risk Assessment.
Okay, let's tie the risks together.
We've covered the internal ones. The cash burn, the share dilution, that crazy 30x valuation, and the opportunities are clear. Voice commerce, maybe even getting acquired. But what about the external threats, the things they can't control?
There are two big existential ones. The first is what we call big tech predation.
Meaning Amazon or Google could just give away similar technology for free.
Yes, they could take massive losses just to crush an independent competitor like SoundHound and lock up the market for themselves. The second is commoditization.
Open source AI models just getting so good that SoundHound's tech is no longer special.
Exactly. If good enough becomes free, their pricing power evaporates.
But you also highlighted a very specific risk for 2025, something investors might be overlooking, the tariff shock.
This is the big one, and it's tied directly to their legacy auto business. Remember, SoundHound gets paid a royalty for every car sold by Hyundai, Kia, and Stellantis.
Right.
If the U.S. government decides to put new, heavy tariffs on imported vehicles, what happens?
Sales of those cars would likely fall.
And SoundHound's royalty revenue falls right along with it. It's a huge macroeconomic risk that's completely out of their control, but it directly threatens the foundational revenue stream that's funding all their future growth.
So if that foundation cracks because of a trade war...
The whole house they're building on top of it becomes very unstable. It's a risk you cannot ignore.
Chapter 7, conclusion.
Okay, last chapter. Let's bring it all home.
So let's synthesize this. The bull case, the elevator pitch, what is it?
The bull case is that voice is the next major operating system, and SoundHound is the only trusted, neutral player. They get 70% growth, zero debt, and that massive 30% short interest is just fuel for a potential rocket ship.
Yeah.
You're betting on them becoming the NVIDIA of voice AI.
And the bear case, why is the stock going to zero?
The bear case is simple. The valuation is absurd. 30 times sales for a company losing money is just not sustainable, especially when your competition can outspend you by a factor of 1,000. The CEO is selling, and a tariff war could cripple their core business. The bears see this re-rating much, much lower, maybe back to that $4 bear case valuation.
So where do we land?
It's a classic battleground stock. The tech is real, the business model is working, but the valuation demands perfection. So at its current price of $12.06, we're calling this a neutral speculative buy. Meaning for an aggressive investor who understands all these risks, the dilution, the valuation, the competition, the potential reward here, at this technical level, might just outweigh the considerable risk.
So, a final thought for our listeners to chew on. As we see more and more antitrust pressure on big tech, and as consumers get more focused on data privacy, could SoundHound's biggest asset be its neutrality? Will being the company that promises not to misuse your data be the ultimate competitive advantage over the next decade?
That's the multi-billion-dollar question, something to think about. Thanks for diving in with us today. And please don't forget to like and subscribe to Stock Analytics AI.
And a quick reminder, this analysis was generated by an AI system using extensive public data, and it's for educational purposes only. It should not be considered financial advice. Please always do your own research before making any investment decisions.